In 1989, Japanese real estate prices had reached such heights that the land beneath Tokyo's Imperial Palace was theoretically worth more than all the real estate in California combined. Businessmen mortgaged their homes to buy more property. Banks competed to lend money against inflating assets. Economists proclaimed Japan would soon own the world. Nobody understood they were living through the peak of the greatest real estate bubble in modern history. What came next destroyed an entire generation's wealth and plunged Japan into 3 decades of economic stagnation. But here's what nobody tells you. The pattern that destroyed Japan in 1989 repeated itself almost identically in America in 1928. And today, in 2025, we're watching it play out again in multiple markets simultaneously. This isn't coincidence. It's a systematic 4-stage pattern that repeats across time and geography with terrifying precision. To understand what's coming, we have to go back to where it all began. Post-war Japan in 1945 was devastated. Cities lay in ruins, the economy shattered, millions displaced. But over the next 4 decades, something extraordinary happened. Japan rebuilt itself into an economic powerhouse. By the 1980s, Japanese companies dominated global manufacturing. Sony, Toyota, Mitsubishi became household names worldwide. The yen strengthened dramatically against the dollar. Export profits flooded back into Japan, creating an avalanche of capital searching for investment opportunities. In 1985, the Plaza Accord forced Japan to appreciate its currency even further to help reduce American trade deficits. The stronger yen made Japanese exports more expensive and less competitive globally. To offset the negative impact on the economy, the Bank of Japan responded by slashing interest rates. By 1987, the central bank's discount rate had fallen to just 2.5%, the lowest in Japanese history at that time. Here's where the pattern begins. Stage 1. Easy money creates irrational exuberance. When interest rates fall dramatically and credit becomes cheap, capital floods into hard assets, primarily real estate. This happened in Japan starting in 1985. With borrowing costs at historic lows, corporations and individuals alike began taking on debt to buy property. Land prices in Tokyo's commercial districts began rising 20, 30, sometimes 50% per year. But the psychology driving the bubble was even more powerful than the economics. Japanese culture had a deep reverence for land ownership. In a mountainous island nation, where only about 20% of land was suitable for development, real estate was considered the ultimate store of wealth. An old Japanese saying held that land prices never fall. This cultural belief, combined with cheap money, created a perfect storm. By 1987, the frenzy was in full swing. Banks offered loans worth 100% of property values, sometimes even 120%, assuming prices would continue rising. Homebuyers took out mortgages they could never repay from income alone, planning to refinance against higher property values in a few years. Real estate developers bought land on pure speculation, holding it vacant while waiting for prices to rise. Corporations diverted capital from productive business operations into property speculation, because real estate returns dwarfed manufacturing profits. The Tokyo Stock Exchange, closely tied to real estate through corporate holdings and bank lending, soared alongside property prices. The Nikkei 225 index rose from 13,000 in 1985 to nearly 39,000 by the end of 1989. Wealth, at least on paper, was being created at a pace never seen before. But beneath the euphoria, Stage 2 was quietly taking shape. Fundamentals detached from valuations. By 1989, the average Tokyo home cost more than 15 times the average household's annual income. And to put that in perspective, even at the peak of the American housing bubble in 2006, the ratio was about 5-to-1 in most major cities. Japanese families were taking out mortgages that would take multiple generations to repay. 100-year mortgages became normal. Some banks even began offering loans that would outlive the borrower, to be inherited by children and grandchildren. The required monthly payments on these mortgages consumed 50, 60, sometimes 70% of household income. Families ate less, saved nothing, sacrificed everything to maintain property they believed would guarantee their future prosperity. What nobody wanted to acknowledge was that these prices made no economic sense. Rental yields in Tokyo fell below 2%, meaning landlords were earning less from rent than they were paying in interest on mortgages. The only way the math worked was if prices continued rising forever. Office buildings in central Tokyo were selling for prices that would take over 100 years of rental income to recover. Yet, investors kept buying, convinced they had discovered a new paradigm where old rules no longer applied. Financial journalists wrote articles explaining why Japanese real estate was different, why it would never crash. Land scarcity was permanent, they argued. Japanese savings rates were extraordinarily high, ensuring perpetual demand. The government would never let prices fall. Every warning sign was rationalized away. By late 1989, the Bank of Japan was growing concerned. Asset prices had become completely disconnected from economic fundamentals. The central bank had inadvertently created a monster, and they knew it. In December 1989, they made the decision that would trigger Stage 3, the sharp reversal. The Bank of Japan raised its discount rate from 2.5% to 3.25%. Within months, it would rise again to 4.25%, then eventually to 6% by August 1999. The era of easy money was over. At first, the market barely reacted. Investors had become so convinced of perpetual growth that they dismissed the rate hikes as temporary inconveniences. But the mechanics of the bubble were now working in reverse. Higher interest rates meant higher borrowing costs. Property buyers who had maxed out their borrowing capacity at 2.5% rates suddenly couldn't afford properties at 6% rates. Demand began to weaken. Then the psychology shifted. In early 1990, prices stopped rising. For the first time in 5 years, properties sat on the market without immediate buyers. Sellers who needed liquidity began cutting asking prices slightly, testing the market. Those small cuts triggered a realization that prices could fall. Buyers who had been rushing to buy before prices rose further suddenly waited, hoping to buy cheaper. In a few months, the mania reversed into panic almost overnight. By mid-1990, property prices in Tokyo were falling 5% per quarter. By 1991, they were down 20% from the peak. By 1992, down 40%. The decline would continue for nearly 15 years. At the bottom in 2005, commercial real estate in Tokyo had lost over 80% of its peak value. Residential property fared slightly better but still lost about 60%. The human cost was staggering. Families who had borrowed 100 million yen to buy a home worth 150 million at the peak now owned a home worth 60 million but still owed 100 million. They were underwater by amounts they could never repay. Walking away wasn't an option. Japanese mortgages are full recourse, meaning lenders could seize other assets and garnish wages for life. Millions of Japanese families became trapped in a nightmare of perpetual debt. They worked their entire lives to pay off mortgages on properties worth less than they owed. Retirement savings vanished. Dreams of passing wealth to children evaporated. The psychological trauma created a generation of ultra-conservative consumers who refused to take on debt or spend money even decades later. But the real devastation hit the financial system. Stage 4. Systemic collapse. Japanese banks had lent trillions of yen against property values that had now collapsed. When they tried to seize and sell collateral, they discovered that properties weren't worth anywhere near the loan amounts. A bank that had lent 100 million yen against a property now owned an asset worth 40 million yen. The 60 million yen difference was a loss that had to be absorbed. Multiply this by millions of mortgages, corporate loans, and speculative property investments, and you get an approximate sense of the crisis scale. Japanese banks were sitting on hundreds of billions of dollars in bad loans. But instead of admitting the losses immediately, banks and regulators chose denial. They engaged in what became known as extend and pretend, rolling over bad loans, allowing bankrupt borrowers to make interest-only payments. Anything to avoid recognizing losses on their balance sheets. This created zombie banks, institutions that were technically insolvent but kept operating. Because these zombie banks were trying to rebuild capital rather than lend, credit to productive businesses dried up. Companies that wanted to expand couldn't get loans. Entrepreneurs couldn't get funding. Innovation stalled. Without credit, economic growth ground to a halt. Japan entered what economists would later call the lost decade, which eventually stretched to the lost 20 years, and arguably continues today. GDP growth that had averaged 4 to 5% annually in the 1980s slowed to less than 1% for the next 3 decades. Stock prices that had peaked at 39,000 in 1989 would take over 30 years to recover that level. An entire generation of Japanese workers saw their career earnings stagnate, their wealth evaporate, their retirement security destroyed. What makes this story truly terrifying is not that it happened. It's that almost nobody learned from it. Fast forward to the United States in the early 2000s. In the aftermath of the dot-com bubble collapse and the September 11 attacks, the Federal Reserve slashed interest rates to historic lows. By 2003, the Fed funds rate sat at just 1%. Sound familiar? This is stage 1 playing out again. Easy money creates irrational exuberance. American home prices, which had been relatively stable for decades, began rising rapidly. Mortgage lenders, emboldened by low rates and a cultural belief that home prices never fall, began loosening lending standards. Subprime mortgages, interest-only mortgages, adjustable-rate mortgages with teaser rates, mortgages requiring zero down payment, all became common. People with no income verification, no job, and no assets were approved for mortgages worth hundreds of thousands of dollars. By 2005, the fever had reached Japanese 1989 levels of irrationality. Television shows celebrated house flipping as easy money. Real estate seminars packed convention centers with people eager to quit their jobs and become property moguls. Homeowners extracted equity from rising home values to buy second and third properties, certain that real estate was a guaranteed path to wealth. In cities like Miami, Phoenix, and Las Vegas, condos were being pre-sold to speculators who never intended to live in them, planning to flip the contracts before construction completed. Banks packaged these questionable mortgages into securities, sold them to investors worldwide, and used the proceeds to issue even more mortgages. Wall Street firms created complex derivatives that bet on housing prices. The entire global financial system had become dependent on American home prices continuing to rise. Then came stage 2. Fundamentals detached from valuations. By 2006, the median American home price had reached 5 times median household income, double the historical average. In bubble markets like California and Florida, ratios exceeded 10 to 1. Rental yields in many cities fell below 3%, meaning it was far cheaper to rent than to buy with a mortgage. Yet buyers kept buying, convinced that real estate was the safest investment possible. What they didn't understand was that the only thing holding up prices was the availability of easy credit. When an unqualified buyer with no income could get approved for a $500,000 mortgage, that created artificial demand that pushed prices higher. But that demand wasn't real. It was debt masquerading as demand. In 2006, the Federal Reserve began raising interest rates to combat inflation. By mid-2007, the Fed funds rate had risen from 1% to 5.25%. This triggered stage 3, the sharp reversal. Suddenly, all those adjustable rate mortgages that had been affordable at 3% teaser rates reset to 7, 8, sometimes 9%. Homeowners with marginal incomes couldn't make the new payments. Defaults began in the subprime sector in late 2006 and accelerated through 2007. As foreclosed properties hit the market, home prices stopped rising. Speculators who had bought properties planning to flip them quickly found themselves unable to sell. They began walking away, mailing their keys to the bank. As defaults mounted, home prices began falling. Once prices fell, the entire structure collapsed. By 2008, American home prices were in free fall, down 20% nationally, over 50% in bubble markets. Banks that had issued trillions in mortgages discovered that their collateral was worth far less than the outstanding loans. Stage 4, systemic collapse arrived in September 2008 with a vengeance. Lehman Brothers, a 158-year-old investment bank, collapsed in the largest bankruptcy in American history. Bear Stearns had failed months earlier. Merrill Lynch was sold in a fire sale. The entire financial system teetered on the edge of total collapse. Only massive government intervention, bailouts worth trillions of dollars, prevented a complete meltdown. The damage was done regardless. Millions of American families lost their homes to foreclosure. Household wealth declined by over $16 trillion. Unemployment soared above 10%. The recovery would take nearly a decade. The parallels between Japan 1989 and America 2008 are impossible to ignore. Both started with central banks slashing interest rates to historic lows, triggering Stage 1. Both saw property prices surge to levels completely disconnected from fundamentals, Stage 2. Both experienced sharp monetary policy reversals that exposed the bubble, Stage 3. Both suffered devastating systemic financial collapses, Stage 4. The four-stage pattern played out almost identically, separated by nearly 20 years and thousands of miles. Yet somehow, the world refused to learn the lesson. Now we arrive at 2025, and the pattern is repeating again. This time the epicenter is China, but warning signs are flashing in multiple markets simultaneously. Let's examine China first. After the 2008 global financial crisis, China responded with the largest economic stimulus program in world history. The government flooded the economy with cheap credit to maintain growth rate. Much of that credit flowed into real estate. Over the next 15 years, Chinese property developers built cities designed for millions of people. Apartment towers stretched for miles. Infrastructure projects consumed mountains of concrete and steel. The construction industry became the backbone of Chinese economic growth, accounting for nearly 30% of GDP. Homeownership became the primary vehicle for Chinese household wealth. Families bought second, third, fourth apartments as investments, convinced that the Communist Party would never let property values fall. By 2020, Chinese property prices had reached absurd levels. In cities like Shenzhen and Shanghai, average apartments cost 40 to 50 times annual household incomes. Young professionals were taking out mortgages that would consume their entire working life. But they kept buying because property had never fallen. Then came Stage 2. Fundamentals detached from valuations. Developers had built so much housing that entire cities sat empty. Ghost cities, some called them, vast urban landscapes with almost no residents. The housing stock in China exceeded demand by an estimated 50 million units. Rental yields fell below 1.5%. The math made no sense, but the buying continued, fueled by easy credit and cultural belief in property. In 2021, the Chinese government decided to rein in developer debt. New regulations called the Three Red Lines restricted how much debt property companies could carry. This triggered Stage 3, the sharp reversal. Evergrande, China's second-largest property developer with over $300 billion in liabilities, announced it couldn't meet debt payments in September 2021. Country Garden, once the largest developer, followed with its own debt crisis in 2023. The property sector that had driven Chinese growth for 2 decades suddenly ground to a halt. Developers stopped building projects mid-construction, leaving buyers who had paid deposits holding contracts for apartments that would never be finished. Property prices in major Chinese cities have fallen 15 to 30% from their peaks. Sales volumes have collapsed by over 60%. Now, in 2025, China is entering Stage 4, systemic collapse. Banks that lent trillions of yuan to property developers and home buyers are facing massive losses. Local governments that rely on land sales for over 40% of their revenue are nearly bankrupt. The wealth effect that drove consumer spending, families feeling rich because property values rose, has reversed into poverty effect. Chinese consumers are cutting spending, paying down debt, preparing for harder times. Economic growth, which the government claims is still around 5%, is likely much lower in reality. The property bubble that powered Chinese growth for 25 years has popped. The consequences will reshape the Chinese economy for decades. But China isn't the only market flashing warning signs. In Canada, housing prices in cities like Toronto and Vancouver have reached Japanese 1989 levels of insanity. The average Toronto home costs over 12 times median household income, and mortgage debt as a percentage of household income has reached all-time highs. Canadian households are among the most indebted in the developed world. Interest rates that were near zero during the pandemic have now risen to 5%, triggering stage 3 for thousands of over-leveraged buyers. Mortgage defaults are beginning to rise. Housing prices have already fallen 10 to 15% from recent peaks, and many economists believe the decline is just starting. In Australia, a similar story is unfolding. Sydney and Melbourne property prices soared during the pandemic as cheap credit and government stimulus drove speculative buying. Now, with interest rates rising and credit tightening, prices are falling. In Sweden, a property bubble fueled by negative interest rates and massive household borrowing is beginning to deflate. Prices in Stockholm have dropped over 15%. Even in the United States, while not quite at bubble levels nationally, certain markets are showing worrying signs. Cities like Austin, Phoenix, and Boise saw prices surge 40 to 60% during the pandemic. Now, with mortgage rates above 7% and affordability at multi-decade lows, those markets are cooling rapidly. Prices are falling, inventory is rising, and buyers are vanishing. The global pattern is unmistakable. Multiple markets simultaneously experiencing the four-stage collapse sequence. Stage 1 was the pandemic-era money printing and zero interest rates that made borrowing nearly free. Stage 2 was property prices surging to levels disconnected from incomes and fundamentals. Stage 3 began in 2022 as central banks worldwide raised rates aggressively to combat inflation. Stage 4, the systemic collapse, is beginning now in 2025. We can see it in rising mortgage defaults, falling property prices, banking sector stress, and weakening economies. What makes this moment particularly dangerous is the interconnectedness. In 1989, Japan's bubble was largely isolated. When it popped, the damage was mostly contained to Japan. In 2008, the American housing collapse triggered a global financial crisis because American mortgages had been packaged and sold worldwide. In 2025, property bubbles exist simultaneously in China, Canada, Australia, Sweden, and pockets of the United States and Europe. The global financial system is more interconnected than ever. Chinese property developers owe money to international banks. Canadian pension funds own Australian property securities. Mortgage-backed securities are traded globally. If multiple property markets collapse simultaneously, the systemic risk is enormous. History teaches us that all bubbles end the same way. The pattern is consistent. Easy money inflates assets, fundamentals detach from valuations, policy tightens, and the bubble collapses. The four stages repeat with mechanical precision. Japan 1989, America 2008, and now multiple markets in 2025, all followed the same script. The variables change, technology evolves, but human psychology and financial mechanics remain constant. Greed drives prices higher during stage 1 and 2. Fear drives them lower during stage 3 and 4. The belief that this time is different, that old rules don't apply, appears in every bubble. It's never true. So what happens next? Based on historical patterns, the outlook is sobering. Property prices in bubble markets will continue falling until they return to levels supported by incomes and rents, not speculation and cheap credit. That process typically takes 5 to 10 years and involves price declines of 40 to 60% from peak to trough. Financial institutions that lent against inflated property values will face losses. Some will fail. Governments will intervene with bailouts, but the damage will be extensive. Economies dependent on property construction and transaction activity will contract. Unemployment will rise. Household wealth will decline sharply for those who bought near the peak. The psychological shift from risk-taking to risk aversion will suppress spending and investment for years. The broader lesson is about cycles and human nature. Real estate bubbles are not new. They have occurred throughout history. the Dutch tulip mania of 1637, the British railway bubble of the 1840s, the Florida land boom of the 1920s, the savings and loan crisis of the 1980s, and now Japan, America, China, and potentially others. The pattern repeats because each generation believes it has discovered something new, a reason why prices can rise forever. They haven't. Economic fundamentals always reassert themselves. Properties are worth what someone with a real income can afford to pay with a sustainable mortgage. When prices detach from that reality, a correction is inevitable. The only questions are when and how severe. For individuals, the lesson is about skepticism and risk management. When everyone says real estate never falls, that's the time to be most cautious. When mortgage lenders approve loans that seem too generous, that's a warning sign. When property prices rise much faster than incomes for multiple years, that's a bubble forming. The euphoria of stage 1 and 2 feels exciting, but it's the prelude to the devastation of stage 3 and 4. Protecting yourself means not over-leveraging, maintaining liquidity, and recognizing that no asset rises forever. It means understanding that easy money from central banks creates distortions that eventually must be corrected. The pattern is clear. Japan taught the lesson in 1989. America repeated it in 2008. Now, in 2025, we're watching it unfold again in real time across multiple markets. The 4 stages: easy money, detached fundamentals, sharp reversal, systemic collapse, play out with depressing consistency. Those who understand the pattern can see what's coming. Those who ignore it will learn the same painful lessons that destroyed wealth in Japan and America. History doesn't repeat, but the patterns do. And this pattern, the 4-stage housing collapse, is one of the most destructive forces in modern economics. The warning signs are everywhere. The question is whether anyone is paying attention.